Okay, on we go. Today we're diving into one of the most powerful income-generating strategies in options trading, put selling. Whether you want to earn passive income, buy stocks at a discount, or build a long-term portfolio, this strategy is for you. First things first, what is a put option? A put option gives the buyer the right, but not the obligation, to sell a stock at a specific price before expiration. If you sell a put, you're taking on the obligation to buy that stock if assigned, and in return, you collect a premium up front. Another way to look at it is as an insurance salesman. The put seller is selling insurance to the buyer to protect against the stock dropping below a certain level. Now, why would traders sell this insurance and sell puts? There's a couple good reasons. First, it's a great way to generate income. Many traders like me use this strategy to earn premium consistently. Secondly, it's a great way to maintain portfolio flexibility, keeping capital on the sidelines while waiting for prices to reach a more attractive level. Selling puts lets you earn money before laying out the funds to acquire the shares. With some brokers, you can earn meaningful interest. I use Interactive Brokers as my primary broker for this very reason. I've added a link in the description if you want to know more. Assuming you have completed the options paperwork and have been approved by your brokerage, you can earn premium with put sales too. The type of account you have will determine the capital requirements for you. For example, a cash account would require all puts sold to be cash secured, which simply means that the full amount of the cost to acquire the shares, should you be assigned, will be set aside until the expiration of the option. With a margin account, the funds required will be less depending on what type of margin account you have. Most would have a 50% requirement, but larger accounts may have portfolio margin, which could mean even less capital would be necessary. Hi there! If you've managed to stick with me this far and found this material valuable, please like the video and subscribe to the channel. It's a big help. Before we jump right into a trade, let's do some homework. Which stocks or ETFs should we use? I look at a number of key factors when deciding on a good candidate for put selling. Firstly, I look for highly liquid options markets, which means tight bid-ask spreads and meaningful open interest. Open interest is simply the number of contracts that are currently open. Next, I focus on securities that I am generally bullish on, meaning that I believe the company's prospects are good and that I wouldn't mind owning its shares, especially at a discount. I also look for stocks and options markets that have favorable implied volatility. Higher volatility means higher options premiums can be collected. While I may have sold put options in lower volatility markets, I may look to add more if volatility increases. Lastly, I look to avoid binary events such as earnings reports or major company events. Even though options in these securities often carry more IV over these events, I have found that these can sometimes have outsized moves, which can negatively affect profitability. A word of caution: avoid speculative stocks going viral. You may remember GameStop a couple years ago, or more recently Bitcoin-related stocks. While an experienced trader may be able to profit from these situations, the beginner may be more suited to stick with the fundamentals. So do yourself a favor, at least starting out, and keep it simple. Once you have settled on the right stock to trade, now we can look at the specifics of the put contract. First, we select the strike price. Strike price is the stock price at which the put seller will buy the shares. Selecting the strike price is a matter of personal preference based on where you might want to acquire shares, balanced with how much premium you want to collect and over what term. For me, I look at charts and technical analysis for my potential entry points. To learn more about technical analysis, I recommend the Technical Analysis Bible, The Technical Analysis of Stock Trends by John Magee. I've owned this one for 30 years. It's the definitive work on the subject. I've included a link in the description. Next, we choose the best expiration, known as days to expiration, or DTE. Deciding on the length of time until expiration includes reviewing the trade-offs between premium, risk, and return on capital. For this strategy, my preference is 42 to 60 days, although I've done shorter and longer. Most traders stick with around 45 days for the best combination of time decay and flexibility. Okay, now let's go through a recent example of a put that I recently sold. I used the ETF ARKK, which I recently featured in another video. I am bullish on some of the underlying holdings in ARKK, including Tesla, among others. It is a security that I wouldn't mind buying at a lower price. In addition, this ETF has higher volatility and a liquid market. Here are the details. I entered the trade on January 27th when ARKK was trading at about $61 per share. I sold 5 contracts of the February 21st, 52 puts, and received 28 cents. So, for 500 shares, I received a total of $140. The cash value of these shares is 500 times $52 or $26,000. From a rate of return standpoint, this equates to a 0.5% return over 25 days. Not great. However, since my margin requirement is considerably lower, this level relative to my allocated capital is over 30% per year. You'll also notice that this trade is very short, only 25 days to expiration. This duration is shorter than usual, but I chose the monthly expiration versus the weekly expiration. It is important to note that monthly expirations will often have more liquidity and open interest than weekly expirations. Now let's talk about trade management. Generally speaking, I'm an advocate of closing trades prior to expiration. I will target 50% to 75% of the max profit to minimize risk. As a longtime option trader, I can't say how many times the last 5 or 10 cents of a trade has come back to bite me. So fight the greed and just close positions as soon as the risk-reward gets out of balance. This means closing early. Depending upon market conditions and the option strategies used, it may also be beneficial to close the positions in about half the time. In other words, close a 42 DTE trade when it reaches 21 days, even if it hasn't reached the profit target. Why is this? Well, if volatility increases or the market moves toward your sold put option, it likely will be worth more to simply replace the position with a new 42 DTE trade and take in even higher premiums. So that's the easy part. What happens if the stock price gets to my strike price early? The good news is that if you want the stock at the lower price, just wait until expiration, and you might get it. However, if you are getting cold feet about the market and owning the stock at this level, you have choices. First, you can close the position at a loss. Tough to swallow, but sometimes the first loss is the cheapest. Second, you can roll the position. Rolling a position is a trader's term and simply means you close the existing position and replace it with a new position. This gives you the flexibility to add time to the trade, or distance, or both. Here's a quick example. Say I had sold the February 14th 63 puts a month ago and collected 28 cents. Now the stock is at 63 with 2 weeks to expiration. I can close the position for $1.88 and lose $1.60 per share. Ouch. Or I can buy back the 63 put and add a new trade on for 50 days at a 60 strike price for a small credit. Alternatively, I can push the expiration out 141 days and move the strike price all the way down to $53 per share. These examples are purely defensive and don't add much profitability, if any. Sometimes not losing money is the victory. A couple quick points about rolling a position. The good news is that if your put is being pressured, the likelihood is that there is increased volatility, which will help the ability to roll out further. The other important thing to note is that you should not wait to roll. It is best to roll early before the price is below your short strike price. The higher cost associated with purchasing the short and trying to roll to a strike price out of the money becomes problematic at that point. Now let's talk about assignment. I practice there is nothing that you need to do at expiration. If the stock closes below your strike price, you will be assigned the shares and the funds deducted either as cash or margin. It is unusual, but you could be assigned if the market moves in the after-hours market. This requires a manual exercise of the option by the owner. Also, there is always the possibility of early assignment at any time. This is also unlikely, but could be centered around year-end tax planning. Both of these are extremely rare, but both have happened to me. If you do get assigned shares, there are a few choices. 1. Sell the shares immediately. This likely would result in a loss. 2. You can simply hold in your portfolio until the price reaches your target. And 3. You can sell covered calls against the position to earn premium and set an exit price. This strategy is known as the wheel strategy, which I will cover in another video. Before I wrap things up, I want to discuss two other important topics: position sizing and portfolio diversification. These go hand in hand and should be an important consideration for all put sellers. As someone who has oversized positions in the past, I can say it is the most dangerous part of this strategy. Size kills. Options provide tremendous capital efficiency, but remember this is leverage and large adverse movements can lead to margin calls and capital at risk. The easy way to solve this problem is to keep positions relatively small. You must also consider portfolio diversification. A strong portfolio should be well balanced and include assets that are not correlated. For example, if you only sell puts on Apple, Microsoft, and Google, a tech bubble bursting would put all of the trades at risk at the same time. Look for differing sectors, indices, or alternative securities, like gold or U.S. Treasuries, to balance out traditional stocks. With today's ETF selections, there are many choices for all types of uncorrelated securities. Keep things balanced. All right, that wraps up today's video on put selling. Selling puts is a great way to generate income or enter stocks at a discount. Remember to close and roll early and keep those sizes in check and portfolio diversified. Now I want to hear from you. Let me know about your put selling in the comments below. If you found this video helpful, don't forget to like and subscribe. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs and consult with a professional if needed.